Hey everybody, welcome to your week in review for the week of Monday, December 19th, 2022. It's Christmas week, everybody, yay! And oh, what a week it was. Monday started off fast. The UMBS were off 44 basis points very early. It's kind of frustration of holiday trading mode because there isn't many people trading. Smaller trades will move the market quite a bit in terms of basis points. No real correlation to this. European bonds have been much more gradual in their weakness. Not much in headlines or economic data. Tesla's shares surged as Musk prepares to step back from Twitter. Maybe. Chinese pro-growth vow for 2023 boost energy and mining stocks. More Fed speakers have said that rates need to go higher. Purchasing Managers Index dropped for the sixth consecutive month. Numbers equate to a minus 1.5% GDP print. Though most people are predicting a positive reading, the Philly Fed took a look at the jobs created in the second quarter of 2022, which is a while ago. According to government estimates, the economy added over 1 million jobs in April, May, and June of this year. Using more comprehensive data, the Philly Fed found that job growth was barely positive. Only about 10,000 jobs were added, which highlights how difficult the Fed's job is when determining this stuff because they can base it off of one set of data that might not be correct. While inflation numbers are the motivating factor in Fed policy, the strength of the labor market has been the justification for hyper-aggressive policy of sequential 75 basis point increases. If labor market is actually tighter than it thinks it is, they might have overshot it at this point and need to chill out a little bit. So nobody really knows what data they're using. That said, when you look at the preponderance of the data out there, the Philly Fed estimate looks like an outlier. So if everything else is different than this, then maybe Philly Fed is the one that is off. The labor market is indeed tight when you look at job openings, the unemployment rate, and wage increases. Builder confidence dropped again, but I'm kind of sick of hearing about that from those babies. You still are basically selling stuff as fast as you can build them. So those of us in the mortgage business can say cry me a river on that one. At the end of the day, the UMBS was down 42 basis points. The 10-year Treasury was up 11 basis points, and the S&P was down about 35 points. We're in that very tight trading range with a convergence of different factors. So we have a ceiling at 101.671, and then a triple floor that is made up of the 25-day moving average, the 100-day moving average, and then a stochastic, or I guess a Fibonacci line at 100.758. Not a lot of data this week, so market fundamentals are going to drive the market and probably people talking like the Fed. And then on Tuesday the 20th, another fast day. UMBS were down a half point early. Rough start to the week between the 2 days. Happy holidays, y'all. Skinny is the Bank of Japan surprised everybody in the market by changing their yield curve control policy. Say that 5 times real fast. It was previously capped the 10-year yields at 0.25%, and now they're allowing them to rise to 0.5%. So this creates a different aspect of competition in the marketplace for government debt. As Barry Habib reported, not one of 47 Bank of Japan watchers saw this coming. We also got housing starts, so it came in at an annual rate of 1.427 million on a 1.4 million forecast. It was 1.434 million previously, down 16% year over year. Housing permits came in at 1.342 million versus a 1.485 million, way lower than we need it to be. Again, that's down 22% year over year. Economic data released yesterday was limited to the NAHB Housing Market Index, which fell for the 12th consecutive month to the lowest point since mid-2012. With the exception of a short period during the pandemic, high inflation and high mortgage rates are causing builders to struggle with keeping housing affordable for home buyers. A lot of factors going into this, including the price of land, price of permits, how long it's taking for permits, price of lumber, all that stuff. So there are a lot of things coming into play, though. Houses are also selling at record paces. So when the NAHB Home Builder Survey fell 2 points to 31, an estimate of +1. Present conditions fell. Future expectations were higher. Traffic was very low at 20. Though I got a feeling if you made them look at traffic numbers from 4 or 5 years ago, they'd be pretty happy with what it is today. So I think the builders are stuck in a basis of what is it relative to, and they should drink a glass of Happy. CoreLogic rent report showed that rental price gains slowed to 8.8% year over year, which is very high, but it's down from 10.2% in September. The NBA came out with its new forecast for 2023. If we had a loan for every time they updated their forecast numbers, we'd have a lot of loans. Total originations are expected to fall to 1.9 trillion. The first quarter of 2023 is projected to be the nadir of this cycle, with total originations to fall to 345 billion before increasing to 510 billion in the second quarter, where it will begin to increase throughout the year. To put 2023 in perspective, it'll be similar to 2018 and much better than 2014. Though I know a lot of people that made a lot of money in those years, so stay at it out there, folks. Mortgage rates are expected to fall through 2023, the 30-year mortgage rate falling to 5.2% at the end of the year. We got a little bit of a rebound throughout the day, so less bad is better than more bad, I guess. We ended the day at 100.89 on the 5.5, which puts us right in the middle of a very narrow range. Like we said, we have a consolidating set of ranges at the 25-day moving average, 100-day moving average, and then that Fibonacci line at 100.58. So there's a lot of floors and support and all that stuff going on right there in that range. We also got some data in non-mortgage world where an oil spill in Kansas that isn't necessarily making the national press. It's going to take years to clean up and cost billions of dollars. The Keystone Pipeline has dumped an estimated 588,000 gallons of oil into Mill Creek in Washington County, Kansas, stemming from an issue in the pipeline first observed on December 7th. The type of oil spill is tar sands oil, which is diluted bitumen. It's thick and difficult to clean up. This is the 23rd leak in the history of the Keystone Pipeline. According to the CFPB, Wells Fargo illegally assessed fees and interest charges to mortgage and auto loans, wrongly had the consumers' cars repossessed, and had payments on those loans misapplied by the bank. Oof. More trouble at Wells Fargo. Wells Fargo will have to pay $2 billion to consumers, really just giving them their money back, but it's also going to pay a $1.7 billion civil penalty. When you start looking at all this money that Wells Fargo has had to pay, you take $1 billion here, $1 billion there, pretty soon it adds up to real money. And on Wednesday, Treasury trading was mostly flat in the overnight with initial gains in Europe. That all changed around 7:30 a.m. for reasons that were kind of unknown. But with light trading that's going on around the holidays, it's generally just having to do with liquidity and volumes not being high enough. UMBS opened up 30 basis points higher on the day. Futures for the S&P 500 rose 0.8% on contracts. The tech-heavy NASDAQ advanced 0.6%. The underlying indices closed higher on Tuesday for the first time in 4 sessions, providing a brief respite to one of the worst years for stocks and bonds in more than a decade. Inflation this year has unhinged the basic portfolio balancing investment ratio of 60% in equities and 40% in bonds. The strategy has plunged 17% in 2022, their worst performance since 2008. Times were not good back then. Contract closings decreased 7.7%, the most since February, to an annualized pace of 4.09 million last month, according to data from the NAR. The pace of purchases, the second weakest since 2010, is below the median projection of 4.2 million by Bloomberg's survey of economists. Consumer confidence did improve in November. The present situation and expectation indices both improved due to consumers' more favorable review regarding the economy and jobs. Inflation expectations retreated in December to the lowest level since September of 21. With recent declines in gas prices, that has a lot to do with it. Vacation intentions improved, which makes people happy, but plans to purchase homes and big-ticket appliances cooled further. Existing home sales fell 7.1% in November, according to NAR. The median home price rose 3.5% on a year-over-year basis, which is more evidence that the home price appreciation is slowing, which it's not the same as depreciation. Affordability has been a big issue, as the first-time home buyer accounted for 28% of sales, which is just above the series low of 26%. Historically, this is about 40%, though we've been in that 25 to 30% range for a couple of years now. Inventory continues to move lower after peaking at 1.3 million in August, though this is somewhat seasonal. It's the fourth consecutive decline that puts us at 1.14 million homes, though 25% of those are under contract. This is 3.3 months with 4.6 6 months considered normal. Although I've heard people say that 6 months is normal, so I think that's subjective. Realtor.com, which is surprisingly owned by News Corp, aka the Fox and Fox News people, showed that rent growth slowed in November for the 10th month in a row. It's now up 3.4% year over year, which is the slowest in 19 months. At the end of the day, we were up 16 basis points on the MBS. Stocks were up 56, and the Treasury was down 1 basis point. We are right here in the middle of this very narrow and narrowing range, with ceiling at 101.671 and a floor at the 25-day moving average, which has been consolidating upward. It is currently at 101.004. We also got news that United Wholesale CEO is purchasing the Phoenix Suns right in my neighborhood. It would be wild to see a championship between the Cavaliers, which is owned by Dan Gilbert of Rocket Mortgage, and Matt Ishbia of United Wholesale Mortgage. They don't like each other. And then also we got from our sponsor at www.WellThatMakesSense.com, processes the role of association, the primacy of associations. I link, therefore I think. This is all about how you can link different things together before trying to sell in order to sell more. So check it out at www.WellThatMakesSense.com. And Thursday the 22nd brought about a pretty muted day, considering we got some pretty big data. At the start of the day, UMBS were down 2 basis points on the open. Treasury were about the same. Then we got jobless claims, which came in at 216,000 versus a 222,000 forecast. It was 214,000 last time. We got third quarter GDP, which was the final revision, which came in at 3.2% when it was expected to be 2.9%. That's not going to help inflation. GDP consumer spending was up. It came in at 2.3% on an estimate of 1.7%. We keep buying stuff. Third quarter GDP was revised upward from 2.9 to 3.2% according to the BEA. The revision was driven primarily by the upward adjustment to consumer spending, primarily in services. The PCE price index component was revised upward by 0.1% to 4.8%. The PCE price index, excluding food and energy, was revised upward 0.1% as well. So now the Atlanta Fed's GDP now model sees a 2.7% GDP growth in quarter 4. So much for the whole air quote recession thing. It is important to understand that the affordability is more than just the mortgage payment. It is also a function of income. Since incomes have been rising at the fastest rate in decades, that helps blunt the impact of the rising payments. October, November will almost certainly be the peak of unaffordability as rates continue to fall and home appreciation slows. As Keynes discussed in Sticky Wages, they primarily don't fall, so higher incomes are baked into the cake already. Falling rates and prices will square the circle. Tomorrow we get the PCE report, personal consumption expenditures. This comes out early for most of the country. Previous reports showed inflation at 6% with a core of 5%. Like we said, it's supposed to be about 2. Market is expecting 5.5 to 4.7. Pretty wide range there. Drop largely because of cooling housing. Shelter is 39% of the number. If that comes in hot, it'll be a bad move for the bonds. At the end of the day, we were down 8 basis points after opening down 2. So a pretty muted day considering some pretty important news there. We also got a great report from MBS Highway where they pointed out that next month we are going to get several new voting members of the Federal Reserve, and some people are going out. So the predictions are that the Fed's going to get much more dovish. Despite a new post from Elliot Eisenberg over at econ70.com, which was a great analysis. Despite rising rates and recession fears, redesign of the home mortgage market resulting from Dodd-Frank and other regulations, which have culminated in substantially tighter underwriting standards, it would take a 40 to 45% decline in house prices to cause damage similar to what we saw in 2006 to 2009. Moreover, back then the average price decline was 28%. This time is definitely different, which is a great analysis from Elliot. Very smart guy. Check him out. We also got a post from our sponsor at WellThatMakesSense.com, another post from the great book Persuasion. Metaphor is a metador. This is talking about how metaphor and Joseph Campbell type stories really kind of walk around people's resistance, and it's a great way to sell things. We had a short day on the bond market on Friday the 23rd, otherwise known as Christmas Eve. UMBS was down 22 basis points on the open, worsened 6 basis points while I wrote my morning post. 10-year yields were a hair higher coming into data and are now a hair higher at the start of the day. We got the core PCE, Personal Consumption Expenditures Price Index, which came in at 4.7% on a 4.7% forecast. It was 5% previously. Durable goods came in at negative 2.1 on a negative 0.6 forecast. It was 0.7 previously. Non-defense, excluding aircraft, came in at 0.2 and was supposed to be flat. Incomes rose 0.4% on a forecast of 0.3%. It was 0.7 previous, so incomes are coming down a little bit, which they kind of need to do so people stop buying stuff so we can get rid of inflation. Outlays came in at plus 0.1% on a 0.2 forecast. It was 0.9 previously, so hopefully people are stopping spending so much money. Tough for the economy, better for inflation, kind of need to do it. U.S. December final Michigan sentiment rose to 59.7 on an estimate of 59.1. Expectations index rose to 59.9 from 55.6 previous month. November new home sales rose 5.8% to a 640,000 annualized rate. New home sales rose to 640,000, like we said. Don't know why I wrote that twice. Estimate was 600,000, so way better than expectations. Median new home price rose 9.5% year over year to 471,200. The average. After passing the Senate, the House will vote today on a new $1.66 trillion government spending bill that gives more money for Ukraine support, restricts TikTok, reforms election certification, and will lead to more Treasury issuance. And that is something the bond market didn't really like, so that's why we were down 20 basis points on the day. We end the week in a very narrow consolidating range. We have a lot of technical indicators colliding with each other right around that 101 mark, and we close the day at 100.72. We also have big support here at the Fibonacci of 99.845, which is supported also by that 50-day moving average. So we have a lot of technicals going into a very narrow range, so hopefully we get some more stability next week. Speaking of next week, we have a Monday closure due to the Christmas holiday observance. We get Case-Shiller on Tuesday, as well as FHFA Home Price Index. Then we have Treasury. We have 2-year and 5-year note auctions on Wednesday, which could move the market. A 7-year note on Thursday before being closed on Friday early for New Year's Eve. So a lot of stuff in a short week next week. And I hope everybody has a Merry Christmas and has a great New Year's. We will have some more posts next week. But in the meantime, check out our common sources and influences, particularly our sponsor at WellThatMakesSense.com.